You just
establishing
watched that
it
video
as a
before
key
this one,
support
the
area.
one with the experts laying out projections, adoption curves, liquidity corridors, and next cycle scenarios. And even though the screen is blank now, your brain is still racing. That feeling in your chest, a quiet mix of excitement and wait, what? Doesn't come from random hype. It comes from intuition trying to connect dots your logic hasn't fully processed yet. Because here's the uncomfortable truth most people won't say out loud.
SEC all out with a joint statement this morning, encouraging banks that host deposits from crypto firms to monitor liquidity and ensure that there are proper risk management practices.
When experts start predicting something as bold as $100 XLM by 2026, they aren't just throwing numbers around. They're synthesizing infrastructure, adoption runway, utility, institutional demand, regulatory trends, and real-world need, and then mapping where all of that actually intersects in the near future. That's why this isn't a pump prediction. This isn't hype. This isn't maybe if the moon aligns. This is models, systems, and networks being built now that could justify valuations that, for most people today, sound absolutely insane. And yet, that whisper you just heard after watching that last video, that's your subconscious realizing that something about this actually makes sense, even if your conscious mind is still skeptical. Let's unpack that. Really unpack it. Most people think price targets are arbitrary until they understand what drives real value. XLM isn't a meme coin. It isn't a community token. It isn't a yield farm experiment. It is a payments and settlement network, one designed not for speculation but for utility. The minute the world starts using Stellar as a backbone for global money movement, everything changes. Utility creates demand. Demand without supply expansion compresses price upward. That's not hype, that's simple economics. Experts don't predict $100 XLM because they dream big. They predict it because they see patterns repeating at a structural level, the same patterns that turned utility networks in tech and finance into multi-trillion-dollar ecosystems. And in crypto, value doesn't scale by headlines. It scales by usage. But why 2026? Why that year? Because the timelines experts keep referencing aren't random. They're based on the way regulation is evolving, the way institutions are onboarding digital asset rails, and the way real payment corridors are being stress-tested around the world. If you follow those developments instead of just the price charts, a pattern emerges. Infrastructure first, price second. You see, each time the market has underestimated the growth of real utility, crypto history has proven that price eventually catches up, and when it does not do so gently. Bitcoin under $1,000 once seemed fine, until it didn't. Ethereum under $100 seemed normal, until it exploded. XRP trading sideways for years felt stagnant, until utility kicked in. And now, XLM sits at a similar inflection point, quietly integrated, slowly building, unseen by the crowd, but unmistakably active to experts tuned into adoption, not memes. This matters because when experts talk about a $100 XLM, they are not talking about a simple pump. They are talking about a repricing to reflect utility greater than most people realize exists today. They are talking about real growth in settlement demand, liquidity adoption, cross-border payments, decentralized finance integrations, and corporate usage. They are talking about a world where Stellar's network effect is actual usage, not just speculative interest. And here's the emotional part that hits hard. Most people will never understand this until it has already begun to happen. They'll look at a chart and say, it moved too fast. They'll blame trends, influencers, or FOMO. But the real story will be that the system worked the way experts expected it to, quietly at first, then undeniably. Because price is a lagging indicator. It always is. Experts don't predict price. They predict conditions. They predict adoption curves. They predict what happens when utility becomes the baseline. And right now, every structural condition experts talk about, institutional demand, payment integration, regulatory clarity, liquidity corridors, multi-jurisdiction settlements, lines up with the narrative that could make a $100 XLM not just possible but reasonable by 2026. Let that sink in, not wild, not fantasy, reasonable based on how adoption actually unfolds. That doesn't mean it will happen overnight. It doesn't mean it will be smooth. It doesn't mean price action will respect your emotions or timelines. It means that there exists a credible pathway where XLM's utility becomes so entrenched that valuation catches up far beyond what retail expects today. And if you felt that subtle, this might be real energy after watching that video, you're not imagining it. Your brain is picking up on a narrative that most people don't want to face because it requires patience, not instant gratification. So yes, experts are talking about a $100 XLM by 2026. Not as a joke, not as hype, but as a data-driven outcome based on adoption, utility, and systemic need. We're going to break down exactly why that number isn't as crazy as it sounds in the next section, looking at real adoption trends, institutional demand signals, infrastructure rollouts, and how utility drives actual valuation. Because when fundamentals line up just right, even the wildest targets start to look inevitable. To understand why experts even allow themselves to say something like $100 XLM out loud, you have to stop thinking in terms of price charts and start thinking in terms of systems replacing other systems. Because that is the lens experts are using, and it changes everything. The first signal they keep pointing to is usage density. Not adoption headlines. Density. How often the network is used, how consistently, and by whom. Stellar was designed for payments, not speculation, which means its growth does not look exciting at first. It looks boring, repetitive, transaction after transaction moving value quietly across borders. But experts know something most retail investors overlook. Once payment rails become habitual, volume compounds without asking for permission. Habitual systems are dangerous in markets. When people or institutions rely on something daily, demand stops being optional. And when demand stops being optional, price stops being negotiable. Experts are watching XLM inch closer to that threshold, where it is no longer used sometimes, but used by default in specific corridors. That default status is where valuation models break upward. Another signal experts focus on is corridor expansion. Not announcements, but geographic reach. Each new corridor adds two things at once: new volume and new trust. Trust matters because financial systems are conservative. Once a corridor works, it becomes a reference point. Other institutions ask, if it works there, why not here? That question spreads faster than marketing ever could. Experts modeling a $100 XLM scenario are not assuming explosive retail demand. They are assuming incremental institutional adoption stacking on itself. 10 corridors become 20. 20 become 50. Each one adds flow. Each flow adds liquidity demand. Liquidity demand compresses supply. And price adjusts. That is how utility assets move. Another piece experts highlight is capital efficiency. Traditional cross-border systems lock massive amounts of money in pre-funded accounts. Stellar's design challenges that inefficiency directly. When institutions realize they can move the same value with less trapped capital, the incentive to switch becomes overwhelming. Experts see this as a slow-burn revolution, not a sudden flip, but the end result is the same: increased reliance on XLM as a settlement asset. This is where the $100 number stops sounding emotional and starts sounding mechanical. Because valuation is not just about how many tokens exist. It is about how much value needs to flow through the system and how often. If XLM becomes a preferred rail for even a fraction of global remittances, settlement flows alone begin to justify price levels that seem absurd today. Experts are not guessing here. They are extrapolating existing flows into more efficient systems. Another signal experts watch closely is regulatory familiarity. Stellar has existed long enough to be understood. That matters. Institutions do not want surprises. They want predictability. Assets that have survived scrutiny become safer choices, not riskier ones. Experts believe this familiarity positions XLM as a comfortable option when institutions finally scale digital settlement solutions. Comfort unlocks volume. Volume unlocks liquidity pressure. Liquidity pressure unlocks price. This is the chain experts keep repeating. There is also the network effect factor. As more participants use Stellar, integration costs drop. Onboarding becomes easier. Tooling improves. Documentation improves. Support ecosystems grow. All of this lowers friction for the next adopter. Experts understand that networks rarely grow linearly. They grow slowly, then suddenly. That suddenly is what people misinterpret as a pump. In reality, it is delayed recognition. Experts also stress that by 2026, the conversation around crypto changes. It stops being about should institutions use blockchain and becomes which rails are already working. At that stage, the market rewards readiness, not novelty. Stellar's focus on compliance, simplicity, and reliability becomes an advantage, not a limitation. This is why experts are not worried about whether XLM is flashy enough. Flash does not move money. Reliability does. Another uncomfortable truth experts acknowledge is that retail participation often arrives late. Not because retail is unintelligent, but because retail is trained to respond to price, not structure. By the time price begins reflecting utility, the underlying adoption is already mature. That is why people feel shocked when targets like $100 XLM start being discussed seriously. Experts are not shocked. They see the groundwork. They see the math. They see the flows. And they know that once utility-driven repricing begins, it does not stop at what feels reasonable to the crowd. It stops where equilibrium is found between demand and supply. And that equilibrium can be far higher than anyone expects. The key takeaway from all expert commentary is this: $100 XLM is not a prediction based on hope. It is a scenario based on scale. Scale of usage. Scale of settlement. Scale of reliance. If Stellar captures even a modest slice of global value transfer, the repricing would shock anyone still anchored to today's numbers. This is why experts keep saying the same thing in different ways. Do not watch the chart. Watch the system. Because by the time the chart confirms the system worked, the opportunity to understand it early is already gone. And that is exactly where we are right now. At this stage, the conversation stops being about whether $100 XLM is too high and starts being about whether people are anchoring their expectations to a world that is already fading. Experts are not asking if Stellar can scale. They are asking what happens when it does. That subtle shift in framing is everything. Because the truth is, most people underestimate how quickly systems compound once they cross a certain threshold. Growth feels slow until it isn't. Adoption feels niche until it becomes default. Experts see Stellar approaching that transition point, not in a dramatic way but in the quiet, technical, operational sense that actually matters. One of the biggest misunderstandings around Stellar is supply. People look at the total number of XLM and stop thinking. Experts do the opposite. They ask how much of that supply is actually available at scale. They look at long-term holdings, locked allocations, ecosystem usage, and operational reserves. When you remove idle supply from circulating supply, the effective float shrinks dramatically. And when effective float shrinks while demand rises, price does not negotiate. It adjusts. This is not speculation. It is liquidity math. Another factor experts emphasize is velocity. Not how fast the token moves on a chart, but how often it is used in settlement. High velocity does not reduce value when demand is persistent. It increases it. Because each unit must be available when needed. Experts understand that settlement systems require buffers. Those buffers create sustained demand that is not sensitive to price swings. Think about that for a second. If institutions rely on Stellar to move value, they cannot simply wait for a dip. They must maintain liquidity. That liquidity demand creates a price floor that rises over time. This is how infrastructure assets behave. They do not spike and collapse. They reprice in steps. Experts also point to behavioral shifts in institutions themselves. 2026 is expected to be a year where digital asset rails are no longer experimental. They become part of standard financial operations. Once that happens, the conversation inside boardrooms changes. Digital settlement is no longer a risk. Falling behind becomes the risk. That mindset shift accelerates adoption far more effectively than marketing ever could. Another overlooked element is cost pressure. Traditional systems are expensive, slow, capital-intensive. In a world where margins are tightening and efficiency is king, any system that reduces friction becomes attractive. Stellar's low-cost structure is not just a feature. It is a competitive weapon. Experts see this as one of the strongest drivers behind long-term valuation growth. And here is where the $100 number stops feeling abstract. If Stellar becomes embedded in multiple layers of global value transfer, remittances, enterprise payments, fintech infrastructure, demand scales across sectors, not just users. That multi-sector demand is what breaks linear models. Price does not increase because of hype. It increases because the system becomes essential across use cases. Experts also stress patience. Utility-driven repricing does not happen on a neat timeline. It happens in waves. Periods of quiet accumulation followed by sharp adjustments. People often mistake the quiet periods as failure. Experts recognize them as preparation. That is why the loudest voices dismissing $100 XLM today may be the most surprised later. Not because they are foolish, but because they are using the wrong lens. They are measuring a future system with present-day assumptions. Experts do not do that. They measure future systems with future constraints. They ask what happens when legacy rails can no longer compete on speed, cost, or efficiency. They ask what happens when digital settlement is no longer optional. They ask what happens when value begins flowing through Stellar not because it is trendy, but because it is necessary. The answer to those questions is where valuation changes dramatically. There is also an emotional component that experts rarely discuss publicly but understand deeply. Markets resist change until they cannot. Once resistance breaks, repricing is swift and unforgiving. Those who hesitated do not get time to reposition comfortably. That is why understanding structure early matters more than timing the exact moment. Experts predicting $100 XLM are not saying it will happen. They are saying it is plausible given the direction of adoption. And in markets, plausibility backed by structure is more powerful than certainty backed by hype. The final point experts keep returning to is inevitability versus surprise. If Stellar continues on its current path, the surprise will not be that XLM reached levels once thought impossible. The surprise will be how long the market ignored the signals. Because when infrastructure finally gets repriced, it does not ask for consensus. It just moves. And by the time most people realize what they are looking at, the question will no longer be whether $100 XLM made sense. The question will be why it took so long for anyone to believe it could. At the end of all this analysis, all these expert signals, and all these quiet shifts happening beneath the surface, the most important realization is simple. The market does not move when everyone agrees. It moves when reality changes and recognition lags behind. And that gap between reality and recognition is exactly where Stellar and XLM are sitting right now. If $100 XLM ever becomes real by 2026, it will not be because people believed hard enough. It will be because systems demanded it, because liquidity needed it, because global value transfer quietly outgrew the rails that once carried it. By the time the charts reflect that truth, the hard part will already be done. That is why this moment matters. Not because of a price target, but because of perspective. Understanding how utility-driven assets actually reprice gives you an advantage that hype never will. It helps you stay calm during boredom, focused during doubt, patient when nothing seems to be happening. And those traits matter far more than timing the exact top or bottom. The experts talking about a $100 XLM scenario are not telling you what to believe. They are inviting you to look at the system differently, to stop measuring the future with today's expectations, to recognize when infrastructure is quietly positioning itself for relevance on a global scale. Whether or not that exact number is reached is almost secondary. What matters is that Stellar is no longer just an idea. It is a functioning, expanding network with real-world demand. And networks like that do not stay undervalued forever. So here's what I want you to do next. If this breakdown helped you understand why experts are even willing to discuss bold scenarios like $100 XLM, take a second and like this video. It tells the algorithm to push conversations like this to people who are still stuck chasing noise instead of understanding structure. Subscribe if you want more deep dives like this, calm, grounded, and focused on adoption, not hype. This channel is about seeing moves before they become obvious, not reacting after they've already happened. And drop a comment below telling me this. Do you think Stellar's real value will be recognized before 2026? Or do you think the market will take even longer to catch up? I read every comment, and they shape what we explore next. Because the quiet phase never lasts forever. And when it ends, the people who understood why it was quiet will be the ones who weren't surprised when everything changed.